Welcome to Front Range Facts. This is Anthony Meisner.
This is Jim Merrion.
We're going to bring you our national update today, and then we'll reel into all of our fun submarkets and local markets here in Colorado.
Yeah, so first I wanted to bring up, there's a company called Zonda that does real estate, market research, and I thought they had an interesting quote because, they talked about how, housing, even when it slows, it's traditionally the first sector to also rebound. As we are hitting higher interest rates, these tailwinds or these headwinds are hitting us with the slowing home price growth, as well as also still challenging inventory levels. While we do see in real time right now a drop in buyer activity, a drop in just overall sales volume, we do expect that it's going to rebound quicker than other areas of the economy, which will be getting hit later on, or just starting to see a downturn in their markets.
So let's talk a little bit about interest rates. This is a big thing because at the beginning of the year, everyone expected home price depreciation to really slow because of the interest rates, right? And here we are, rising interest rates even more so than we probably thought, and it's not affecting the home pricing markets as much as expected by Fannie Mae, Freddie Mac, and MBA, and all of our other sources. Look at NAR, we're talking 16% to 9% now. This is almost double what they were at the beginning of the year.
Yeah, and I think what Anthony and I were at the beginning of the year were remarking was how we felt the projections were really off for appreciation for the year. They were too conservative because when we entered the year, there was zero inventory. I mean, not zero, but it was so low. It was so low that there was just nowhere to go but up with prices. And so it was really surprising to see the low, conservative kind of appreciation rates being spit out by all these companies. And so now, they've recalibrated because January through May were just incredibly crazy prices, over asking price. And so we're seeing now moderation of that. There's a lot less homes that are going for over asking price now, a lot less multiple offer situations. So we're seeing it kind of reduce it. But, if we didn't see the last few months of reducing it, the appreciation forecast for the year would probably be breaking 20% in a lot of these forecasts.
Absolutely would. I mean, this was more extreme than last year.
Yeah. Oh, yeah.
So that being said, this is much more realistic expectation for the year. But compared to last year was 20+%. Here we are at, call it 11, 12%. That monetary and fiscal policy really is doing its job.
Yeah, it is. And so, while we, do, complain, maybe that sale volume is slowing down, we're on a really unsustainable track. And so overall, this is a long-term healthy thing for us. Here you can kind of just see what the appreciation rate was looking like getting into the 20% level for March, April, May. And really the only reason June was 18.3 was because at the end of May, we saw interest rates increase, in some cases break over that 6% mark, taking the wind out of the sails. Otherwise, we would have been at the 20s throughout the whole summer. It would have been really, really expensive.
That's very expensive. The worst part about that is affordability. So that's why we threw the slide in here. I mean, you can finally see that 100, that metric at 100 is really that's kind of what the target is, right? I mean, that's kind of the country norm across the U.S., or at least that's what they would like to see, right? That's like a average income can afford an average home kind of thing.
Yeah. No, and I think that what I love about this slide is just that it looks at a 30-year picture basically of activity, and to see kind of where affordability was in the 2008 recession time period. Obviously very, healthy, good prices for people, and that continued for quite a bit. And then we hit this, area where we had no affordability this year. We just totally hit a wall with this 20% increase in prices that jumped the shark in a lot of cases. So
it's like a 50% shift in affordability, mainly because of interest rates, but also, like we said, 11% price appreciation in the market, that'll do it. All right, so what about mortgage rates, Jim?
Well, this slide's a little outdated, because today's interest rates are 6.5% or something like that. But, as of, the beginning of this month, September, 5.66%, to show, basically this is just a year picture. It's just from the beginning of our year. But God, look at, January 6th, this is just 3.22, and today's rates are double what that was. So of course it's going to have an impact on the market. And if you're new to this market, whether you're a first-time buyer or whether you're, first-time realtor or whatever else, you're probably hating life a little bit with this. But for long-term people in the industry, this is healthy to kind of get back into these normal realms, because this is sustainable. Everything else leading up to this has been very unsustainable. We've been on a track for a year and a half. Unsustainability.
Absolutely. All right. So monthly mortgage payments. This is a really interesting one, and this would be like average home price across the country average. So mortgage
$340,000 mortgage roughly.
right. It would basically be 20% down on a conventional $400,000 house or something, right? So earlier this year when we were at that 3.2%, $1,200 a month. Now we're at about $2,000 a month. And if you want to put that into perspective here in Colorado, assume that those loan amounts are almost double that usually, at least in this area in Boulder, but much, much higher. So when you look at the swing, it's just pretty incredible how we could go that far. So if you look at this, here's what happened from like the average person's income, right? We haven't really been at 25% of a family's income for their housing for quite some time, since 2006.
Out of $4 going to their household income. I mean, if this tracks from January of 2000, right, and started at 19.6% of the family's income was going towards paying the mortgage. When it got really frothy in 06, 24.7. So clearly we hit a red flag by breaking over that 25% mark, where it's becoming unaffordable. And that's where that long-term sustainability market is evaporated, right? So we need to get back down to earth a little bit with this. So it's
will definitely happen. Yeah, good sign. Median household income versus qualifying income. This came from NAR as well. But the one thing we wanted to talk about here, the Midwest is in a really extreme in one direction. The West has 4 of the top 5 most expensive states,
including Colorado,
right? So that's where Colorado is so much more extreme than everywhere else in the country.
This is there's clearly trends in not only showing activity in the West, but also in just how much further out home prices have gotten from the average home buyer in the Western region, and it's reflected clearly here more than anywhere else.
All right, so Jim put together this really nice sort of table.
Thank you, Anthony.
Wonderful.
Thank you. I work hard at what I do.
So here's the most important part. You really only need to look at one column because all the columns are the same. But this is just over basically the last month, right? We started about 5.5%. Here we are today, closer to 5.75 or 5.5% or 6.5%. I'm sorry. And that alone, at our loan amounts here, basically went up almost $500 a month. The craziest part about this is what happened from that 3.2%.
Or even this beginning of the year. I mean, we basically have added, $1,600 a month to borrow $750,000
to buy the same exact home, right? So that's why we're feeling the slowdown we are, and the cost of money is very expensive. Yeah. All right. So what else?
So just some recommendations, whether you're a home buyer or you're in the real estate industry as a lender or a realtor. Suggestions are to help people expand their search area and criteria. Maybe look at smaller yard size, or maybe look a little further out from that area. There's some really fantastic creative lending going on right now too, and that you're seeing like 2-1 buy downs where they reduce the interest rate by 2% the first year, 1% the second year, doing other types of creative ways to reduce the impact by going with ARMs or other things. And then also downpaymentresource.com is a great little source. It aggregates every single down payment program in the country. So if you have somebody who really is struggling with the down payments because interest rates have gone higher, have them check that site out.
There's a lot of grants. I'm actually always surprised at how much money is being given away to help with affordability.
This feeds into what we were talking about a little bit with the West having the greatest impact. So showing time, the folks that do the majority of showing logistics, the bookings of showings and whatnot for us realtors. Obviously, showing traffic has gone down. Sales volume overall by lenders, I think, is down 29%, for the year compared to last year. So everyone's seeing a bit of an impact with less demand, and the leading indicator of that is always the showing activity. It's about 90 days out from closes. So seeing a 16.8% national drop in showing activity, but out west, because the affordability has gotten so much out of whack, a 44% drop in showing activity, which just goes to show you we need more sustainability in our market. So even though this hurts in the short term, long term, it's going to be much more healthy for us.
All right, so total home sales, this is national. We're going to look at this on a state level basis, and we're going to look at it by all the submarkets here. But they all kind of are trending in the same direction, right? We were really impacted by a shortage of inventory in January and February, right? We had great interest rates, but we just didn't have enough homes for sale. Then you get into that spring market where you start to get inventory coming on the market, and slowly the interest rates start to climb for us. So we're going to fall short of those numbers we saw last year, which, like we talked about, were just unsustainable. Too many people moving. Money was really cheap. It was causing all the prices to go up. But here we are kind of settling into whatever our new fall market is going to look like. This is home sales in thousands. So we really did come short by 150 million. Is that right?
150,000 for
150,000.
Yeah. So keep in mind, no one expected really to have higher volume this year in home sales than last year. The simple reason that we started the year off with such a rotten level of inventory, and so we had lower levels of sales, even when interest rates were still fantastic. We expected it to stay lower because nobody was putting their homes on the market like they had historically. And now with the interest rates rising, you can clearly see really in June and July a massive impact with the interest rates.
And when we get into the August data that we have locally, it just goes to show you how much more extreme this is going to get before it changes. So on a national level, this is the other metric that I really like to look at because it measures buyer demand, right? The buyers out there in the market, they're still really hungry, right? Everybody needs a place to live. Lots of people still would like to purchase a home. But we're talking about 14 days on the market, right? That's active to sold, or active to under contract. I mean, not active to sold. And in 14 days, it's 2 weeks to put a house under contract. That's like a bargain compared to history. Yeah. I mean, you can look at here in history.
Beginning of 2019, yeah, roughly.
We're talking, 30, 40 days at any given time throughout the year. Obviously, that trended down the farther we got through COVID because demand had risen so much. The other part about this is the pending home sales have obviously started to fall off. But you look at that baseline, right?
That's the 10-year baseline, right?
10-year baseline, yeah. So that 10-year baseline at 100, that's like our healthy level historically. This is only the third time in a decade we've actually been below the healthy level. Yeah. So we really did need to cool off. I mean, look how extreme it got there over the last couple of years.
Yeah, it's one of these things where I think it's important to look at the fact that we were already starting to drop with pending home sales before the interest rates hike because, again, that inventory got to be so low and affordability started to get so difficult for people. So it's natural just to see a drop off in the pending home sales. And here's where, I got to reiterate this because there's so many stupid headlines out there, people. The fact is these, editors out there have these headlines that really want to drive your traffic to read their articles about the impending collapse of the housing market. But this is the reality of it. There are almost no distressed homes for sale. If you don't have distressed homes for sale, you don't have massive price reductions in your inventory. So you're not going to have a wave of foreclosures or a wave of short sales that's going to give you that bargain you've been waiting 28 years to do. Get off your ass, buy a house. You can't time the market rate, and there's not going to be a discount coming up, guys.
Absolutely. And we have a couple more factors to show you when it comes to Colorado with the distressed properties. They're just not available. They don't exist. We have so many trillions of dollars in equity in the U.S. market. Yeah. It's not going anywhere.
So 2011, right? Or I say 2021 is to 2011 till now. So looking at over an 11-year picture of time here, basically with months supply of inventory. And historically, economists say that 6 months of inventory is where it's a balanced market where buyers and sellers kind of have equal ammunition. We had that in 2010, 2011, where we had lots of inventory, right? But we haven't had that since then, and the last few years have been just dropping like a rock with inventory. It's been a seller's game, and there's discounting going on for sure, but you're not going to get more than a few points off of asking price, and that's about all you'd be happy to get at this point.
I put the little blue dot right there. We're about our balanced market. It's just not even close, right? So you can kind of get a feeling for that. Now, let's look at year-over-year inventory levels, and you can really just see how inventory has fallen off and fallen off and fallen off for years, right? So that baseline right there, 0%, is do we have more inventory on the market or less than we had the year before, right? So, I mean, basically, for the last 2 years, all we've done is eat away at inventory that in places like Colorado, we didn't really have to begin with.
So from 2014, which is where this graph starts, we have most it is 2014. Yeah. Most years, we're starting off. Most months, we're starting off with less inventory than before. So what this is the point of this is that we have so many months where we've had less to sell than normal that even if volume increases of active inventory, there's a huge trough you got to dig your way out of to even have an impact on sale prices.
It's exactly where our premises come from, right? They're just not building enough homes. We have more home buyers every year right now, and here we are digging ourselves deeper and deeper into this. So that's what's created a lot of the housing market. Now, This is interesting because this is the 20 city composite, which I really
Case
like.
Filler, it's a pretty famous, index that they kind of look at the top 20 cities in their eyes about price changes. And year over year, finally starting to see, sorry, 20, yeah.
Yeah.
It's just finally starting to see, a drop in that home price change, back lower. But again, look at that February through May, really frothy, getting a little bit unhealthy there.
Those 20+% numbers definitely need to come down. And honestly, they probably need to come down to about 10% before anybody's going to be happy with this. So we might have a little ways to go. All right, so total home sales, the forecast from basically last January to current, there's a lot going on here, right? So we basically were projecting 7 million homes sold. Where's the bounce mark? You were telling me 6 million, 5.5 million?
5.5, 6 million is kind of where things are a lot more healthy. So we're starting to see with all these, downward revised forecasts, getting closer to that standing level, but we're not going to see that until 2023 at some point in time.
Here's the other part. We wanted to show you just another iteration of where that balanced market is and when we were really in a balanced market, right? So those neutral markets only happened a couple of times. We tend to be in really strong sellers markets, or we've been in a few buyers markets because of things like, well, the Great Recession. So when real estate caused it, that's where we put into that big buyer's market of 7+ months of inventory, but it didn't last long, right? 2007 to 2011 or so. And then right out of those balanced markets back into seller's market. I think this articulates so well where today is and how far off of some extreme change, right? If you're a buyer, you're not getting a deal. You're still going to be lucky just to get a house. Probably you might have a little bit to shop for. At least you might get the house you want now. But there's not going to be 5%.
Well, this is national too. And, we're at maybe 3 months of inventory. Nationally, I think it's 2.9 is what it comes out to. Here in Colorado, we're still like scratching too. We're trying to hit 2 months of inventory, if we're lucky. So, national numbers are very favorable for continued home price steadiness. If not appreciation. And expect in 2023 to see still a 4% increase or so in home prices nationally, because part of that is the fact there's no inventory to sell. And then, in Colorado, we're always stronger with our market. It's reflecting the fact that we have 2 months of inventory instead of the national 3. And then you couple that with the fact that the builders have really turned and ran from building new stuff. And, if you've paid attention to our podcast over the last few years, you know that we've been underbuilding for years. And even if we were building 1.5 million homes a year with new construction, which we did hit last year, it takes 13 years to get all that inventory that we lost from the 2008 fiasco to fill the blanks. So we've got a very solid, resilient market.
My biggest concern with this market we're heading into is that the builders are pulling back again because they got burned so bad in 2010. And here we are going to create an even larger inventory shortage. And that is really concerning to me. It's really concerning for the Colorado market.
It's our whole concern. I mean, this is, as soon as the market shifted in May, Anthony and I were talking, we're like, this is so bad for the future home buyers because it's going to be this, a boomerang effect where it's going to cause new home prices to increase so much in another year or so. Once, these home builders stop, freaking out every quarter about their quarterly stuff and actually think about long term.
Well, I mean, it takes them 2 years to develop lots even before they can break ground. So, I mean, that cycle is far too long for them to make knee-jerk reactions. And unfortunately, there's no incentive for them to continue that process through these downturns. So then we end up with shorter and shorter inventory.
Mm-hmm.
All right, so I'm Anthony with Land Title. You can always reach me on my cell phone if you have questions, 303-968-9868 or ameisner@ltgc.com.
I'm Jim Merrion, realtor here with Coldwell Banker. I can be reached at 303-548-0243 or jim@ourcoloradohomes.com. And, we walk through the national news, which we just did now. We're going to cover the state news next and head over to the local, markets after that.
Don't forget, you can reach us at frontrangefacts@gmail.com if you want to email the show, you want any of our slides, you just want to tell us how great we are, those kind of things. And if you want to catch us on our blockchain podcast, Get Real with Blockchain, anywhere you find your podcasts.
So again, just a little bit of information about the showing activity, which always precedes sales by about 90 days. If you're expecting some good sales coming up, this is showing you're not going to get them.
The only problem here is we're about 30% off of where we were last year, right? We were starting to pick up a little bit towards the end of August. We were kind of bridging that gap a little bit, you could say. And with the interest rates highs recently, it is slowing showings even more. So
further.
that is going to be a real concern going into the next few months. The biggest problem with that is we usually have pretty strong showing traffic all the way into, at least Halloween, most of the time mid-November, right? So I'm a little concerned with 6.5, 7% interest rates on the horizon if that's going to happen,
Mhm.
where that's going to drive showing traffic. So just be mindful of that if you're working with clients. Be mindful of that when you're pricing a home right now, whether you're, an actual homeowner. If you're a buyer, that means that you probably want to buy sooner than later this year for sure, because the longer we wait, the higher these rates seem to
Yeah,
go.
and new mortgage business is down 29% year over year. You can clearly see why, based upon the fact that the showing activity started to really drop significantly in April, and even in March. So that obviously is a trend to see, and you're going to continue to see low activity because it's kind of flatlined here.
Single family homes in the state of Colorado, right? So the state of Colorado data, interesting things is obviously new listings are going to slow down coming out on the market when there's less buyer behavior. People are starting to feel that. They're starting to pull back a little bit, right? We're down 11% from this time last year. But year to date, new listings are basically flat, right? I mean, 75,000 homes came on the market in Colorado so far this year. The real issue is pendings from last year to this year are down 18%. Now, year to date, they're only down about 15%. That's going to come out in the wash somewhere around that 15 to 20% for the year, from what we can tell. That being said,
And that's why the sold listings are down 13% as well. But because that new listing activity is still lower, the sale prices are still higher. And of course, it was buffeted by the beginning of the year when we really front loaded a huge amount of appreciation gain. But here's where even if you bought a home at the beginning of the year and you went 80,000 over asking price and you lose your job in the oncoming recession, guess what? You've got enough money to break even at least. If you need to sell your home to get some equity out of it, and there's obviously other tools that are not as extreme, which is just some refinancing, getting HELOCs, whatever else it is. You've got equity though, and that's what's the amazing thing. That's the buffer here for the market's health long term.
yeah, I mean, that's great. And the best part about this is you still have a lot of buyer behavior in Colorado. Days on market are still only 31 to sale. So that's a big deal. Plus the housing affordability, you saw us talk about this earlier on a national level, we're like 98.5%, which isn't great, but Colorado's at 55%. It is half as affordable as the national level. So that being said, that's something to watch for the state of Colorado. If we look at the townhouse condo market, there's a few changes there, right? The townhouse condo market's actually only 75 instead of 55. So that's a big difference. But a lot of the other stuff is kind of trending in the same direction. Now the average sales price for the attached product is up a little bit more than we saw in the detached market, 14% year to date, 12 to 13% for that median. So it is getting more expensive to live in Colorado, coupled with higher interest rates, making it much, much less affordable. But that's what all this stuff is doing, right? It's starting to turn a lot of that down. Now, for total sales, we are down about 23% in August, but we're down 17% from year to date in 2022. Now, if we look at some of those pendings and new listings, we're talking 20% down in under contracts, which is a little bit more extreme than the detached market, and the new listings are down just a little bit, right? We were pretty flat in detached. The attached market's down about 10%.
And the affordability index is 75 versus 55, so obviously it remains more affordable in the townhouse condo market, but still from a national perspective in comparison, it helps to reflect why Colorado is not the fifth most expensive state.
Okay, so here's one thing I wanted to talk a little bit about when we look at the state. Let's look at some history, right? So I really like these slides because they give us all the way back to 2010. Now, so active units on the market, right? This is total active inventory. There's 15,000 units on the market in Colorado right now. That shouldn't feel that extreme when we have, millions and millions of people living here. Now, we haven't had 15,000 units on the market since it's been a while, right? I mean, we're still not even back to those 2018, 2019 levels. We're still really low, especially for this time of year, right? The seasonality is occurring. It comes and goes every year. What Jim and I were talking about is just how incredible it is that the townhouse condo market doesn't fluctuate. It's not nearly as volatile.
That's a blue line at the bottom there. Look at how, there's a little bit of an undulating rhythm, but it's so much less extreme than the seasonal fluctuations of the single family home, which, we probably attribute to the fact that there's not as many families, school-based kind of decision making, things like that steer things. So it's more of a consistency to the overall market.
So as you can see, it's going to take many years for the tide to rise, even with increased listings coming on the market. So that's something not to be scared of. We really just don't want you to shy away from doing real estate right now, right? I mean, I don't think there's any reason not to. Now, the month supply of inventory, like we said, balanced market being 6 months. Here we are, 2 months of inventory on the market. Like we said, we're scratching the surface there. And the detached market's only at 1.5 months of inventory, which is so extreme, right? When we were back in 2019, 2020, we actually had more attached inventory than we had detached, which is not normally the case, right? It generally trends back and forth a little bit, but usually that attached market follows the detached market, and the detached market kind of leads the way. So that was getting to be a little bit of an anomaly, but COVID was quite the anomaly in itself.
I mean, point being here that there's a lot of resiliency in this market, even if interest rates go up. A lot of people have the capacity to hold on to their homes, not be financially distressed about it. And because 92% of all people out there own a home that has less than a 6% interest rate, there's very little incentive to get a huge fluctuation in increased inventory because people are locked in with the rate.
Absolutely. Now, the days until sale. So this is days on market. This is active to sold, from my understanding, on a statewide basis. It's a little bit different than what we see the national slides going, but here we are, closing on loans in 31 days, right? I mean, this is still incredible. The mortgage industry has done an incredible job through COVID of speeding this process up. I mean, they probably cut 15 days out of the closing time period.
It's amazing what pandemics can do for incentives.
Technology changes really go well when they don't have any other options. So that being said, lots of resiliency in this market as well, and just as fast as houses are turning over, this is pretty incredible. So this is still a really good sign for the state of Colorado. As Jim was talking, this is that metric where we're talking about distressed properties. CAR finally put this out. It's pretty interesting to watch. Short sales in the month of August were 1. So if you're looking for a bargain,
statewide, folks,
they don't exist.
And REOs are foreclosures. So there were 10, which is a drop from 12 the year before. If you're in this situation, you have taken a torch to your house and left it with no equity, because nobody should be in this situation given how awesome our market has performed.
Absolutely. Just stay away from the meth pipe. That's probably
rule number 1.
And I'm Anthony with Land Title. We're going to get into the local markets next, but you can always reach me on my cell phone at 303-968-9868 or ameisner@ltgc.com.
I'm Jim Merrion, realtor here at Coldwell Banker. My phone number 303-548-0243, or give me an email at jim@ourcoloradohomes.com.
All right, so let's first touch on the biggest market in Colorado, the metro area. This is a little more extreme than a lot of Colorado because, well, there's less inventory, there's more home sales, there's more people moving here. Like, there's a lot of reasons, right? But interest rates affect it just like everything else. So for years, we've had just hyper low inventory. I mean, it's been extreme. But the good news from July to August is we did see a little bit of an increase in the pending numbers, right? So we saw some people come back into the market shopping. But keep in mind, 6,600 homes are on the market. That is way too low when you have a metropolitan area of a couple million people.
And you can clearly see the impact of high interest rates. In late May, right around Memorial Day, there were some lenders, a decent amount, that were breaking 6% interest rates, right? And here you can see the pendings and the solds peak right about then in May.
Yeah, so here's kind of the May area, right? So April was the peak month. May was really where you saw that fall off in the under contracts there. And because of that, that's where you start to get that big spike in inventory. Now, we recovered a little bit. It takes 60 to 90 days for buyers to kind of acclimate to that market. Now sellers are acclimating to the new buyers in the market. So it's kind of this transitioning period, which we're going to talk a little bit about and you'll see here. But two of the most important things that we need to talk about in order to understand what's happening in the market here is month supply of inventory and how that plays in, and then how long it takes to sell a home. So month supply of inventory dictates a lot of like what sellers are doing in the marketplace. You have some pretty extreme swings from the heart of Denver, Arapahoe County, Jefferson County to somewhere like Elbert, because Elbert's at almost 3 months of inventory. Denver's at 1.3, right? 1.3 being 5 weeks. So we went from 1 week to 5 weeks, right? That doesn't seem nearly as extreme of a swing as it may seem. So that resiliency in the Colorado market, just the fact that this is such a desirable place to live, has really kept Colorado insulated from a lot of what's happening nationally that we talked about earlier. The big part of that is buyers are not letting go, right? I mean, buyers buyers are still really active. We may have had one of the hottest markets in Colorado in the country, right? We were at 8.5, 9 in April and May. These were some, I mean, things are going under contract.
It was very unhealthy.
And healthy is very strong. But when you talk about the difference between then and now, we're talking 9 days.
So but look at where it was, just a few years ago. It's totally different animal stuff.
Exactly. So we expect this to get somewhere closer to 30 by the end of the year or so, because I mean it's gonna slow down a little bit every month from here to the end of the year, traditionally, seasonally anyway. But then that coupled with interest rates is gonna make that a little bit more extreme. And we haven't quite felt it yet as much as you would think.
And 2018, 19 in numbers is kind of where we're going to be, headed back to, which was very healthy. It was a good market. It was still very seller driven. It was somewhat balanced in that people maybe didn't have to make a decision right away, but there was still quite a few times where you're in competitive situations, you needed to make a quick decision, and so we're not getting too far off of things. We're just getting away from the 100K over asking price for a given for every single deal.
So we showed you this slide nationally, the total sales year to date. You can see just the extreme swing in Colorado. Colorado has really had a lot less sales because it had so many sales during COVID, right? The anomaly of 2020 and 2021, we're kind of getting closer to reality again, because we needed to slow down. So the market is slowing down quite a bit, and you can see when the interest rates really started to hike, that really started to curb those sales.
June, July, August is definitely a lot lower than it would be normally.
25% down year over year, just in the month of August. So that's a big one. This is the other one, is we're not quite to a fall market yet, right? We're not back to that norm that we would start to see this time of year. We're still at 99% listed sale price. So that means people are getting nearly full price offers all of the time. Depends on the sales or the price point, right? Obviously, certain price points are going to do better than others, especially those ones where it's more competitive.
Mm-hmm.
I mean, you see it across all these different price ranges. But
we're more affected by interest rates. It's the buyer is more affected by interest rates. Yeah, like the 600K, like you were saying.
Yeah, 600K is a really expensive price point because jumbo financing is a little bit cheaper than traditional financing right now, which doesn't always happen. And then you've got a lot of buyers falling out at the lower price ranges too. So that being said, we're headed there. We're heading to a fall market. We're definitely going to get there, probably in the fall, which is a good sign. But we were so extreme in the spring that this is bound to happen, and this is really, really healthy for the market. Let's get into Larimer, Well, Boulder County, and El Paso County. That's the last one we've got to talk to. Let's compare some apples to apples here. It's pretty easy to see how fast the tide rose. I mean, you can see this. The average sales price was getting out of control.
I mean, look, this is Larimer data. And, the blue line represents 2022, red line represents 2021. So to see the jump in that sale price, and then look at, 2019, that green line, right? Like to see in the median close price for a single family home be a little bit over 400,000 and now be at that 575 range in, 3.5, 4 years. It's a $175,000 increase in the median price. A lot of protection there in case there is an economy drop for people. And it just shows that at some point, which is now, we needed to retreat from this ever-escalating environment.
All right, so the other slide that's looking at is, let's look at the supply side. So this is what are sellers doing, right? Active units on the market. They're really similar to where they were last year. No one would think that, especially with what the media is throwing out there. So we like to bring you truth. And the truth is there's just as many active units as August of last year. Now, the new listing traffic is down. Now, why is it down? I think it's because that buyer behavior is starting to slow, scared a lot of sellers into just holding on. Interest rates rising affected the buyers then affect the sellers. So this is kind of a chain reaction. Now, you would expect with the buyer slowdown that happened earlier that this would happen sooner, but it really took all the way to August before you saw a big pullback from the sellers. Mm-hmm. So they're down about 10% from the previous month, but almost 20% from the previous year. Now, demand, this is the buy side, right? So what are buyers doing? Yes, they're out, and yes, they're active, but they're 22% off of last year, which that's exactly what interest rate hikes were supposed to do, right? Now, the month supply of inventory is only at 1.6. So this is
extremely... Well, I love this slide, with the month supply of inventory showing what 2019 was, with inventory levels and where we are in the blue line with 2022. I mean, there's so much room here still for the market.
Right here just goes to show you what a balanced market in Colorado would have looked like. And we were in one, and the market felt great, right? It didn't feel that bad. Now, if you're a seller, it took a while to sell a home. Proper expectations, proper planning, maybe it wasn't.
2019, I remember having so many conversations about we need to price it exactly in line with the comps. And if we did that, we were able to get it under contract within 14 days on the market, and everything worked out good. And so that's kind of where we're heading back to, guys. Price it in line with the comparables. The market's not going to be lifting up much. Just make it a smart decision on where you put your prices.
Absolutely. So let's get over into the Weld County stuff, because Weld County is a little bit cheaper than the Larimer County region, right? So our friends out in Weld, they're starting to drip into the market here in the Denver metro. It's really starting to affect that. We're 10%, 11% above where we were last year. You can see, though, that that's starting to curve back down a little bit. I would expect to see that kind of level out finally, because we had such an extreme market at the beginning of the year, or towards that April-May timeframe, where we had all those extreme price changes, and here we are getting closer to maybe some more sustainability, right? Which is good. The median's doing basically the same thing. Get into supply. Actually, there's quite a bit more supply coming onto the market in Weld County. That's always good to see, because there's some resilience there with sellers, but they were also
well, it's interesting because the new listings, there's clearly a rhythm with how close all those lines are with it. And just this year we're seeing starting to see active listings increase, but again, look at where 2020, 2019 were with active listings. There's still a lot of ways to go before there's any type of real price pressure on things.
Absolutely. You can see here the month supply of inventory is still 1.6. We were at 5 in 2019, right? It was a little bit more extreme in the Larimer County area, but very similar, right? This Weld County area and the Larimer County area and Boulder County area, they all follow the same trends, right? I mean, Colorado is desirable, so people that have the choice to pick, they land all over the Front Range. Now, that Weld County portion there, the pending is under contract and really back to the 2019 levels, so that's a good sign. Single family, here would be the
Boulder County.
Yes, in Boulder County, the most expensive county on the Front Range. 1.1 million is our average sales price. It's still rising quite a bit. It bounces around, but basically similar to Larimer County, similar to Weld County. We're seeing it above last year, but those prices are coming much closer to the 2021 prices. Supply, very similar, right? We're starting to rise. We're seeing that rise. It's curbing off with some seasonal norm. People have pulled back on the new listings as well here. Now, the other part about this is demand. Demand has seemed to curve off a little bit faster in Boulder County. I would attribute that to these higher price points, and largely due to the cost of money being more extreme. Like we talked about earlier, it could be a $1,600 a month swing for
just for a $750,000 loan, and if you're looking at homes that are $4 million, $3 million, and you are financing it, well, we're talking different numbers for those kind of things.
Absolutely, and 2 months of inventory. So Boulder County does have quite a bit more inventory than anything to our friends.
And again, if we're looking comparison to 2019 with that green line of how much month supply of inventory, it's substantially different markets.
It's remarkably better, right? So the last thing that we want to talk about is always don't forget about our friends in Springs and in El Paso County. Really similar stuff happening, actually. Jim and I have been talking for years about how the month supply of inventory down there has been so low.
Yeah.
They're at 1.9 months of inventory, right? It's all in line with the same thing that we're feeling across the entire Front Range. Inventory is rising. That's not a bad thing. It's going to cool the market down quite a bit. They're still at 99.7% listed sale price in August. That is actually remarkable, because they're basically getting full price offers across the board, which means there's still some bidding wars in the spring.
Well, and they only have, in the townhome condo, only 1.2 months of inventory, which is still nuts. I mean, anything under 4 months is
unbelievable,
pretty frothy. And this is just, it's tough still. And that's, El Paso's the value buy along the Front Range, and you can see how they're fighting it out right now to get a good value on those townhomes.
Yeah, the other part about this is just the days on market still down there. If you look at the townhouse condo market, it's only in 12 days. I mean, that's unbelievable compared to the rest of the markets on the Front Range, and the single family home market's in 17. So that being said, strongest market in Colorado is still in El Paso County. Hasn't changed in a long time. Thank you for coming on the show today. I'm Anthony with Land Title. You can reach me on my cell anytime at 303-968-9868 or ameisner@ltgc.com.
Jim Merrion, realtor here at Coldwell Banker, 303-548-0243. Feel free to shoot me an email at jim@ourcoloradohomes.com. Have a great one, guys.
Don't forget to check out our other podcasts. If you ever get bored, Get Real with Blockchain, anywhere you find your podcasts. Bye.
Take care.